Hello, everyone. I'm Joel, your host for Talking Trends, where we explore trends in real estate and all things luxury in the greater Sarasota area. Today, we're very excited to have Scott Kolbe with us, a vice president at South State Bank, to talk to us about mortgage rates. And I think we go way back, right?
Way back.
Yeah.
Yes, sir.
So obviously helps a lot of my clients with their mortgage situations. He's done several of them for me, so I feel like he's part of the family. So
Thank you, Joel.
welcome, Scott. And again, I think we just want to explore a little bit about what's going on in the mortgage market. I think we're almost halfway through 2022. Reflecting comparative to 2021, what's happening?
Sure. It's been a very interesting year for us as well in mortgage. We haven't seen a great variance in terms of the amount of, dollar volume lent, but we have seen our transactions dip a little bit. Year to date compared to 2021, we're about the same from a dollar volume standpoint, but the units are less. So we're very much benefiting from the rise in price and appreciation that we've all felt, so far this year.
Yeah, and I think that's obviously very consistent with us. Our transactions overall are down, but obviously our total volume is up,
Yes.
just because of price increases, et cetera. And how are you feeling going into the rest of the year? I mean, is it trending positively?
Yes, it is. I mean, we've seen, of course, interest rates be impacted at the Fed level with changes to their perspective on pricing, but it's not slowed us down, dramatically.
Right.
And what we're sensing is a very normal rate environment. I mean, certainly higher than the past, but very
Right.
normal.
Yeah. And is there any segment that you're dealing with more? Is it the under half a million, million, over 2 million? Anything that's bigger than the others?
No, I don't think so. I mean, we've done loans in the 5 million range all the way down to 50, 60,000, to be honest.
Yeah, interesting.
Yeah.
And so it's always one of those interesting things. We're obviously dealing with, price appreciation year to year. And one of those factors that always plays in with financing is appraisals. What are you seeing out there? Are appraisals coming in?
They are. Yes,
Yeah.
yes, they are. Um, there's a lot of pressure on appraisals.
Mhm.
Time adjustments in terms of sales and comparing dates of sales is under a lot of pressure. They have to keep up with the market. They have
Yeah.
to understand that 30 days is a substantial amount of time in an appreciating market like this. So the appraiser qualifications certainly have been tested,
Mhm.
but no, we're not seeing massive appraisal issues right now.
Yeah, which is very interesting. I just think we haven't seen them either, really, in our financing deals, any real appraisal challenges, with maybe an exception or two. But
Right.
again, it's been pretty manageable. So diving right into interest rates and what's
Mhm.
happening with them, I mean, what are the three most prominent factors that influence those rates?
Well, I think today we're dealing with inflation. I think we're dealing with rise in prices. We left over from supply chain issues of COVID, and the Feds and their monetary policy. I think through the end of this year, it will be what the Feds indicate they're going to do with rates and how well they're going to ward off inflation and rising prices, and so on. So I think it's a matter of their stance with projecting what their increases are going to be, through the end of the year.
Right. And I think it's always an interesting factor. People are throwing out interest rates as something that will slow down the real estate market. And again, but there's some other factors. You just hit on a few that kind of are the flip side of it, right? Inflationary environment, real estate's actually a good hedge,
Mhm.
in an inflationary environment. And the stock market, is somewhat volatile right now. So again, real estate still an interesting part of a portfolio, right? So there's all these competing factors that
Right.
play into the real estate market, which obviously make our jobs interesting.
Very much so. Very much. Yes.
um, so, you know, I guess just we take that subject a little farther. Let's kind of dive into interest rates, kind of
Mhm.
what's happening, where they are on different types of instruments.
Sure, sure. So today, we see adjustable rate mortgages becoming very popular again. In the past, probably the past 5 years, we've been in just unequivocally a 30-year fixed rate market. Everybody wants a 30-year fix.
Mhm.
Well, with the rise in rates, the arms have become a lot more attractive. You can you can get an adjustable rate mortgage that's fixed for 5 or 7 or 10 years, all amortized over 30, and the rate is substantially lower in some cases.
Mhm.
So it offers interest rate relief, and also fits kind of their plan and
Mhm.
their life expectancy with the mortgage. Most folks don't hold mortgages beyond 7 years. So to have a 7 or a 10-year ARM at a discounted rate makes a lot of sense.
Yeah, yeah, definitely. And so conforming rates for a primary residence, where are we?
High fives today,
Okay.
depending upon credit score, loan to value, loan components,
Yeah.
but that gives you a general basis.
And what about a jumbo?
Jumbo, actually, for the first time in that I can remember, jumbo rates are lower than the
Interesting.
conforming rates, and I think that's because most of them are held by banks,
Right.
and so we're balancing off of our liquidity to
Interesting.
lend money. But the jumbo rates are in the high, mid fives,
Mm-hmm.
and conforming rates are in the high fives today.
Yep. And so I think people, they hear 5 and they kind
Mhm.
of take a step back because we've been a little jaded right over the last few years
sure.
about low rates. So in the big picture, is 5 to 6% a bad interest rate?
Well, that's what I said in the intro. We're in a very normal rate environment, and even us doing this every day, we have to research that to keep ourselves optimistic and stay positive in the fact that rates are very normal.
Mm-hmm.
Going all the way back to the 60s and 70s, every decade that we've seen, the rates have been this high, if not higher.
Right.
Year 2000, when we turned the calendar year 2000, our rate was 8.03%.
Yep.
So rates are not high today.
Right.
They're normal. And I think we just have got to get psychologically used to, no longer a 2.75 30-year fix, which isn't really healthy anyway.
Right. And we knew that wasn't real.
Right.
Right.
Wasn't going to last.
It was all artificial. So, I mean, again, we're really, just like the real estate market, I think overall we're just going back to some normal, a normal market, a normal feel, a normal approach. There's a lot of factors out there that play in, and
Yes.
none of them, not one is driving everything. They're all kind of competing almost.
Correct.
So it's interesting.
Agreed.
And obviously, there's always unique situations out there with buyers. So obviously, just conventional based on income, et cetera. But do you ever do things based on portfolios or investment portfolios or that type of thing as an alternative?
Well, when we've got some very aggressive underwriting guidelines for asset dissipation and the way we look at assets as potential income streams.
Right.
I think you have to be good at that here in this area with the amount of retired folks that we have that have high net worths. So yes, we do a lot in our portfolio. We do have asset-based kind of lending mechanics that create income streams out of asset bases.
Yep. And so land loans or construction loans. Yeah.
Yep, we do lot loans with the intent to build. We have 2 and 3 year balloons on those, and then construction to perm loans are also very, very popular. New construction has become very popular. Many that are needing mortgages were only able to get new construction contracts accepted,
Right.
Because the market was so competitive. So the new construction is very, very popular. So we do construction to perm loans, which would prevent clients having to close twice to build and then roll into their permanent loan. So it's a great loan.
Nice. And I know we were dreaming and hoping that international buyer comes back. So what about international buyers and international lending?
We don't do a lot of foreign national lending. That's something that has really tightened, mostly because it's non-recourse lending. So you see a lot of lenders pull away from that.
Yep, exactly. And there's certain banks that will do that. It's their expertise.
It is their expertise. They're fit. For sure.
And so fun stuff. So in the last couple of years, what's the biggest loan you've done?
$5 million.
All right. Excellent.
$5 million.
And the lowest?
Lowest was 49,000.
There we go. A little diversity.
Yeah. Guess which was the hardest?
the 49 for sure.
That's right.
We know how that works.
Yes.
Well, awesome. Any other things you want to throw out there? What's going on in the market? Predictions for where interest rates will go? I mean, the $1 million question.
Yeah, I think I'll answer that. Will tell you that rates are going to do one of 3 things. They're going to go up, down, or stay the same.
Sure. Yep.
It's so hard to predict right now. I don't think anybody predicted that rates would be where they are, today. So we just have to stay very tuned to what's happening, what those economic indicators tell us. I think it's really important as an agent to stay close to your buyers. And if you're actively looking for new property, make sure that you're routinely in touch with your lender to make sure your pre-approval is still good because rates have changed, and you don't want that to impact what you qualify for.
Right.
That would be my
Yeah,
my
yeah,
advice.
yeah, makes sense. And I think again, from our perspective, we're always watching rates and very cognizant of them, but they haven't really impacted per se the market. There's a lot of things at work together, but interest rates haven't really driven anything down. They're just a factor that everybody has to put into the equation now when they're buying.
Seems like more of a psychological issue than a financial issue.
Yep, yep, absolutely.
Yeah.
Thanks again, Scott, for being with us. Thank you for being with us. This is Joel Schemmel with Talking Trends. See you next time.